Hey guys, so I recently started using a weird but surprisingly effective investing strategy. And right now, that strategy is safely generating me 5 figures a month in passive income, which means I no longer need to rely on an unstable business income like I used to. This strategy also allows me to grow my portfolio using unconventional assets that give business-like returns. And all of that allows me to stay financially independent without losing sleep about short-term performance. Now, I am not an expert or a financial advisor, but this strategy has been working well for me. So I wanted to show it to you in this video, explain what I'm investing in and why I think this strategy could work well for you too, if you're a lifestyle entrepreneur like me. But first, why not just listen to normal investing advice? Why don't typical investing strategies work for entrepreneurs? Well, the problem is that most normal investing advice is made for normal people, and normal people normally have jobs. So a job holder is trading most of their upside potential in exchange for higher stability. And so that is who most mainstream investment strategies are targeting. But business owners and job holders have very different risk profiles. And basically, if we compare you as a business owner to that person, your income and your net worth is already much more volatile before you even start to think about your investment portfolio. Now, you probably both want the same thing, right? Financial independence and peace of mind. That's what everyone wants. But the pathway that you've chosen to take is very different. And because you're on this different pathway, you should probably also consider investment strategies that better align with that pathway. And that's why most typical investing advice won't work that well for you and why you should consider other options. So what investment strategy does work for entrepreneurs? Well, first, let's take a look at how most entrepreneurs invest. And specifically, what do the most successful business owners invest in that the rest don't? The answer to this was harder to find than I expected, but let's take a look at a couple of good sources that I found. So this chart from Visual Capitalist doesn't separate between job holders and business owners, but it does show that as someone gets wealthier, their allocation shifts and they start to hold less real estate, more bonds, more stocks, and much more of their net worth in their own private business. Here's another piece of the puzzle. The Hampton Mastermind recently did a wealth survey of its members. So they're all business owners with net worths between under 1 million to greater than 100 million. And as it turns out, as business owners become more successful, their portfolio changes to include a larger percentage of net worth in their own business and a smaller percentage in public stocks or public businesses, a larger percentage in crypto, and a larger percentage in cash. And the most successful business owners who are worth more than 100 million, they were the ones who actually held the most in cash. So while I was thinking about how I should invest, I learned a lot just from this data alone. First lesson I learned is the business owners who made up this data, they weren't investing more in their businesses because they were getting wealthy from somewhere else. They're getting wealthy because they own businesses. In other words, the best bet is on what you know best. You'll probably get the best ROI by just doubling down and investing in yourself as an entrepreneur. So how can you do that? There are 3 different ways. First, you can invest in your own business and just make sure it has as much capital as it needs to grow. Second, you can invest in other strategically similar businesses. If your business doesn't need any more capital, then put it into another one. And third, invest in yourself. So acquire new skills, develop your human capital, and build relationships. So that's going to give you a lot more leverage to grow your main source of wealth, which is probably your business. So that all sounds great and it makes a lot of sense, except for one big problem. When you bet everything on yourself, you're literally putting all of your eggs into one basket, and that feels risky as hell. It is risky as hell. Why? Because things don't always go our way. Eventually, at some point, it always turns the other way, even if for a little while. Shit happens, you run out of stock or something, or you can't fulfill a product, and your business just drops by 40% overnight. Or maybe you're all in on crypto. You know what that's like. I've had these things happen and I know how it feels. It doesn't feel good at all. Personally, I think that is because it's so easy to build up this sense of identity and ego around your income or your net worth when it's growing quickly. So when things are going great, I feel great, but when it starts to go down and turn south, it feels terrible. And that's actually a great way to sabotage everything that you're working towards. Because when you're too heavily invested in one thing, mentally or financially, and whether it's your business or an investment, and then that thing takes a big hit, you actually end up performing a lot worse. You get emotional, which then makes your judgment worse, which then makes your decisions worse, which then makes your actions worse, and that puts you deeper and deeper into the hole when you most need to be getting out of it. If you play poker, it's called being on tilt, and it's the basic reason why being all in on something for too long for most people just isn't a good idea. So technically, yes, it's true. If you're a business owner, your best investment is going to be in your own business and your skill set first and foremost, but realistically, it's not the only thing you should be doing. And personally, as I get older, I'm in my mid-30s now, I want to be able to start start taking more and more chips off the table so that when things don't go my way, and they don't sometimes, then I have something safe to fall back on. And ultimately, I want to be able to sleep comfortably at night. So because of all of this, I began asking myself a question. How can I diversify my income to feel more financially secure and still grow my net worth while not being completely reliant on one asset or one business? Is there actually a way I can, have my cake and eat it too? And I figured out there actually is. Now, keep in mind that investing is personal. This is just what works well for me. There's no one size fits all best single strategy. Morgan Housel says that investing is not about maths, but it's about finding a strategy that maximizes how well you sleep at night. And so what makes me sleep well at night may not be the same for you. You've got to understand your own situation, goals, and limitations and just create a strategy that suits you. But my goal is to be financially unfuckwithable. I don't want anyone else to be able to take away my lifestyle freedom. And so to get to be financially unfuckwithable, I needed to find a balance between two different things. First, stability. So that's keeping my money safe and then earning a guaranteed, reliable income per month that I can live off. And on the other hand, growth. So that's growing my money, growing my net worth at the cost of experiencing volatility. The thing is, stability, or keeping money, let's call it, and then rapid growth, or let's call it making money, they require two really different approaches. So if we want to have both of these things, we need to think about them as two different things in our portfolio. And this is where a particular two-pronged investment approach can help. This is the same strategy that helped Nassim Taleb make millions even through major market crashes. Taleb used this approach to create what he called a barbell portfolio. So this is all about embracing those extremes. So just picture a barbell with two heavy weights on either end. On one side, you invest in the safest assets, and on the other side, you invest in the most high risk, high reward assets with not too much in between. So you've got the safe side or the money keeping side that secures your money while creating a reliable income stream. So this is what gives you the peace of mind and a safety net when things go bad. On the other money making end of the barbell, you own assets with the potential for massive returns. But the key is to keep the two sides separate. One end of the barbell provides the stability, and the other end drives the growth. And what about this middle ground zone, the bar in the middle? Well, Taleb would argue that middle ground assets like the S&P 500 are still exposed to significant risks despite having limited upside potential. But they're pretty overvalued because everyone else wants to take the middle ground option. So his recommendation is essentially avoid the middle. And the barbell approach is unconventional but effective. It's like having the best of both worlds. So you have the security of a reliable income stream and price stability, and then the excitement of big windfall gains. And remember the dangers of playing on tilt. You make worse decisions, you act worse, you lose more money. Basically, we can avoid this completely with the barbell approach. All we need to do is make sure that our emotions are based around the safe end of the barbell and not the risky end. So you can let the risky end yo-yo up and down and do whatever it needs to do in the short or the medium term while you sleep comfortably because you know that your keeping money stack is completely safe. And maybe you're watching this and you don't think that this separation is important, but just trust me on this. I've had enough experience making and then losing millions of dollars to know that being on tilt, it's the worst thing you can do for your net worth and for your business. And through those experiences, I finally figured out that the secret to winning the game is just to not mind what happens. And so having a well-constructed barbell strategy with the two ends separated allowed me to do that. So here's how I built my own investment portfolio based on the barbell strategy. On one end of the barbell is my money keeper fund. So this is the safe side of my portfolio that generates stable income. It's 5 figures a month now because I've been building it up. It lets me sleep comfortably at night and it lets me live a good life. And personally, I'll only consider something a money keeper if it meets 3 to 4 of the following factors. Firstly, liquidity. Can it be quickly converted into cash? Second, cash flow. Is it paying me stable cash flow or is somehow reducing my expenses? Third, stability. Is the price or the value changing often or is it predictable or stable? And number 4, passive. Is owning this asset completely hands off or do I have to do work to maintain and manage it? So these are the assets that I've allocated to my money keeper end of the barbell. Gold. It's been a store of value for thousands of years, probably will continue to be. Doesn't pay any dividends or cash flow though. Real estate, you could put this in other places. To be honest, this is mainly my personal residence because it saves me on cash flow because otherwise I'd have to pay rent. There's cash here and short-term treasury bills. So unlike long-term bonds, treasury bills don't have any price risk because you hold them to maturity. And interest rates right now are really great, so they're earning over 5%. So about 3/4 or 75% of my money keeper fund is in treasuries, and the rest is spread between the gold, cash, and real estate. And so in total, that side of the barbell, that's about 30% of my portfolio. Then moving on, we have the middle ground between the two barbell ends. Now, Obviously, there's some leeway in how you categorize different assets, right? So you could invest in very risky individual stocks or even bonds as part of your moneymaker strategy on that other end. Or you might even consider bonds as part of your safe money keeping fund. But I think if you're mostly index investing, so something like the S&P 500, then the returns, you probably call them middle ground returns. You might argue that real estate should be here in the middle too. I think that depends on the specific type of asset. But since I'm following a barbell strategy now, so I've got in my middle ground close to 0% of my portfolio here. The majority of my portfolio, or about the remaining 70% basically, is allocated to the money making side. So what goes on this side of the barbell? It could be your main business or any other private business stocks you own. Again, they're pretty high risk. It could be public stocks, higher risk public stocks, I mean. It could be crypto, or basically any other instrument you're using to obtain these higher risk, higher reward returns. Now, even though right now I'm not actively working on any business, looking at it this way, looking at the barbell division, I'm still 70% risk on. I'm still in 70% money making mode. Of the assets that I consider money makers, I'm holding the majority in crypto and specifically Bitcoin for now. Now, of course, that will change over time. And the way that I'm playing the current crypto cycle is just, if it goes up, I sell some and I move that money over from my money maker to my money keeper side of the barbell. So over time, although they're unbalanced at the moment, they will start to balance out. I'd also like to start or maybe invest in some other businesses as good opportunities present themselves. Because as we learned before, a business is still the most reliable way to increase your wealth in the long term. But for the meantime, I'm pretty satisfied with Bitcoin's track record as being a moneymaker. Yeah, it's risky, it's volatile, but the returns over time, they're kind of on par with owning a business. Most years, you more or less double your money. And it's actually been the best performing asset class for the majority of its life so far, which is cool. So the beauty of thinking about your investments like this, including your business as well, is that you're giving your portfolio the opportunity to double or significantly increase most years, but all of the volatility that's associated with that upside is mentally partitioned off as part of this one end of the barbell, because you also have your money keepers ticking away on the other side in the background, generating reliable cash flow so you can just live your life, not worry about the day to day. And then as your money maker fund starts compounding over the course of years, or you have businesses that are ready to sell, so you start having exits and this fund is growing a lot now, then that excess wealth can waterfall down and overflow into the money keeper fund. And by doing that, having this one-way flow, you can permanently increase your passive income cash flows. And eventually you will get to the point where you have enough in your money keeper fund to cover your living expenses indefinitely. And at that point, you really have FU money. So that's the barbell strategy, and that's my personal moneymaker, money keeper portfolio allocation that's working very well for me. So here's a few simple tips if you want to put this into practice for yourself. First, build the money keeper end of your barbell. When selecting assets to allocate here, remember the 4 factors: liquidity, cash flow, stability, and passivity. Then identify your living expenses or burn rate. Figure out how much income you need to feel secure even if something goes wrong. That amount is the target income that you want to be generating from your money keeper fund. Third, avoid tilt by living within the means of your money keeper fund. Or if you're not there yet, aim to do so as much as possible. If you can do this, it means you will never ever get into a situation where you're backed into a corner on tilt and making bad decisions, because you have this bulletproof foundation, even in a worst case scenario. Fourth, value your business and allocate it correctly. So make sure you know how large your business is relative to the rest of the portfolio and correctly allocate it to the money-making end of the barbell so you can see what your real risk profile is. If you're not sure how to value your business, honestly, most common small businesses are worth between 2x and 4x profits. Or think about it this way: if you didn't own your business today, how much would you pay to buy it? Once you've done that, and as long as you're happy with the allocation between the two ends, then embrace the risk of the money makers. Double down on your business if you want to. Keep a crypto heavy portfolio like me, if that's what you want. Then review and rebalance. So periodically move the excess profits in a one-way flow from the moneymaker fund to the money keeper, and just let time grow both of those funds. And then enjoy being unfuckwithable. Keep your head clear, stay out of tilt, and enjoy your new wealth. They say happiness equals reality minus expectations. Well, to me, being wealthy equals having your means above your desires. And so becoming wealthy means increasing your means and managing your desires. Wealth is not a number, it's a feeling. I believe that a financial strategy focused on increasing means only without acknowledging the importance of managing desires is doomed to failure. But I'd love to know what you think. Leave me a comment down below. And if you want to hear about the $10 million mistake that I made that led me to actually needing to create this strategy for myself, click here, watch that video, and I'll see you there.